This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hi, we're going to talk now about the other group statement. We've dealt with the statement of financial position. We've dealt with profit and loss and OCI. Now we've got cash flow. And in the first question, we could be asked to adjust a cash flow statement, or possibly in a later question, we could be asked to comment on where things are recorded in the cash flow statement. Again, this was revised in 2025, so if you studied financial reporting shortly before then, you may need to relearn a little bit because things have changed a little bit. So what we need to do is say, how does the statement of cash flow look? And then specifically, what are the issues if you've got a group? The statement of cash flows is, as it always has been, in three sections. An operating section, an investing section, which tends to be, doesn't it, related to largely things which are in non-current assets, and a financing section, which tends to be things that are in long-term liabilities and in equity, give or take. Now let's look at this, and particularly at things that changed back in 2025. First of all, the reconciliation between profits and cash, again, which in the previous version of the standard used to start with profit before tax, now starts with simply operating profit. So we start with operating profit and no other number. Remember, IFRS 18 required the use of the word operating profit in the profit and loss. And then we add back things which are not involving cash. So these non-cash items like depreciation, amortization, impairment, profit on sale of PPE and so on. And then we adjust for working capital. If you are very rusty on basic cash flows, you may need to look back at our financial reporting lectures, because you certainly need to know how to put the numbers together. So there's the operating section, underneath the investing and the financing section. What I want you to notice is this. Investing activities include dividends received, but also interest received. So whether it's dividends or interest, they're investing activities. They're not operating activities. And then financing activities. Financing activities include both dividends and interest. Does that sound familiar? Yes. Dividends in, investing, dividends out, financing. Interest in, investing, interest out, financing. There was a time when there was much more flexibility. Many companies used to show interest in another section of the cash flow. Doesn't matter where now because they're not allowed to. Interest and dividends in investing, and out in financing. So that's the basic shape of the cash flow. And when we prepare a cash flow, you can either use traditional T accounts or a little bit of a schedule, but you perhaps remember that what you would want to do is to reconcile the opening and closing position in the balance sheet. So if this is tax, brought down 10 from the balance sheet, carried down 15 from the balance sheet. I'd find the charge in the profit and loss, 5, no that's too easy isn't it, we'll make it 8. And then I can balance off this ledger account and therefore see 1818 what the cash flow is. So the cash flow out is therefore 3. If you don't like that, you could use a schedule. Brought down 10, profit and loss 8, miss a line. It works just the same, doesn't it? Carried down in the closing balance or statement of financial position 15. Cash drops out as the balancing figure, therefore, which is 3. Don't forget in cash flow statements, you must show the brackets in the correct way. So you will be significantly penalised if your brackets are all wrong. And I do mean significantly, because the examiner doesn't really like half marks. We are going to be moving into group cash flows in this chapter. When we look at group cash flows, we're going to introduce 3 lines. Sometimes we buy a subsidiary, and if you buy a subsidiary, you might have to therefore spend money. So in investing activities, we may well see acquisition or disposal of sub. We'll talk about it later. Buying the sub is an outflow. Selling the sub is an inflow. In addition, we also might see dividends floating around if we're looking at a group cash flow statement. So it could be that you pay a dividend out. Now, if the parent pays a dividend out, we've already covered it. But if you think about a group in these terms, here we are, P and S. If I just draw that as a balloon, if you imagine that S pays a dividend, if S pays a dividend, let's assume it's an 80% subsidiary. 80% goes to P, which means that group cash goes down and up again, but 20% goes out here. And that's a dividend to the other owners of S, the non-controlling interest. We're going to talk about that very shortly. So we see this extra line here, which I'm highlighting again in blue, dividend to NCI. We'll see it in just a few minutes. It could be that you've got an associate. Legally, associates are not part of the group. They sit outside, they float outside the balloon. So what might happen though is that the associate pays a dividend in, and that of course would be a dividend from an associate. If it's a dividend from an associate, we're going to see that now. Let me just see if I can see it. Once we do, we'll highlight it in blue. Dividend from associate, there it is, inflow of cash. So in terms of introduction, bear in mind the yellow points. The yellow points are, this is the format, and if you studied cash flow before 2025, you may have learned a different format. Starts with operating profit, and also interest and dividends, in investing and out financing. And then the blue points, which we'll talk about in later lectures, are that in group cash flows, we'll have some extra flows, buying subsidiaries, receiving money from associates, and paying money to the NCI or minority owners of subsidiaries. That's it. Thank you.